You know at 60 you're supposed to be smarter with your money, not reckless, but there's one mistake, one decision that can wipe out everything you've built. And if you're not careful, you'll learn this lesson the hard way. I've seen it too many times. Smart people, hardworking people, throw away their life savings because they ignored this simple rule. And trust me, it's not what you think. Here's the truth. If you chase high, risk get rich. Quick schemes at 60, you're playing with fire. Your time horizon isn't 30 years anymore. One bad bet, and you can't recover. No do-overs, asterisk, but it's not just speculation. It's debt. Borrowing against your home, gambling on sure things, or letting fear drive your decisions. That's how people lose it all. At 60, your job isn't to swing for the fences. It's to protect what you have. Compound interest doesn't work backwards. So ask yourself, are you being patient or desperate? Because the difference decides whether you retire in peace or in pieces. You've spent decades building your nest egg, making careful decisions, and letting compound interest work its magic. But here's the hard truth. At 60, you don't have the luxury of time to recover from a big mistake. One reckless gamble, whether it's a hot stock tip, a speculative real estate deal, or some can't lose an opportunity, can wipe out years of progress in months. And when that happens, there's no going back. The problem isn't just the loss itself, it's the psychology behind it. When people see their peers making quick gains, fear kicks in. They start thinking, I need to catch up, and that's when rational thinking goes out the window. But the market doesn't care about your urgency. It punishes desperation just as surely as it rewards patience. Worse yet, high-risk bets often come disguised as safe opportunities. Maybe it's a friend's surefire business venture or a complicated investment product with dazzling return. But if you don't fully understand it, or if it sounds too good to be true, it probably is. And at this stage in life, you can't afford those kinds of lessons. The smarter move, stick to what you know. Focus on preserving capital, not swinging for the fences. Let the young investors take wild risks. You've already done the hard work. Now, it's about making sure that work isn't undone by one moment of impulsiveness. There's a dangerous myth that debt is just a tool, no matter your age. But after 60, borrowing against your home, taking out personal loans, or using leverage to invest isn't a strategy. It's a trap. Debt doesn't just eat into your cash flow. It turns small setbacks into full-blown disasters. And when you're on a fixed income, there's no easy way out. Think about it. If you take out a loan to invest and the market dips, you're still on the hook for payments. Except now, your investments are worth less. Or worse, if you tap into home equity and can't repay, you risk losing the roof over your head. That's not investing. That's gambling with your basic security. And it's not just formal debt. That's the problem. Even harmless credit card balances or financing big purchases can snowball. Interest compounds just as powerfully against you as it once did for you. The difference is, now you don't have decades of earnings ahead to dig yourself out. The bottom line, if you wouldn't pay cash for it, you probably shouldn't borrow for it. At this stage, debt isn't a tool, it's an anchor, and anchors sink ships. Fear and greed have bankrupted more investors than any market crash. At 60, those emotions are even more dangerous, because you're not just risking money, you're risking peace of mind. When the market drops, fear screams at you to sell before it's too late. When others are getting rich, greed whispers that you're missing out. But both are liars. The worst part, these emotions don't just lead to bad decisions, they compound them. Sell in a panic and you lock in losses. Chase a hot trend and you'll likely buy high just in time to sell low. It's a cycle that erodes wealth not in one blow, but through 1,000 small cuts. And it's not just the market. Fear makes people hoard cash, ignoring inflation's slow drain. Greed pushes them into investments they don't understand, like crypto or private equity, simply because everyone's doing it. But following the crowd is how you end up broke with the crowd. The antidote? Write down your plan and stick to it. Define what you'll invest in, how much risk you can stomach, and when you'll walk away. Then, when emotions run high, you've got guardrails to keep you from driving off the cliff. Complexity is the enemy of the wise investor. The older you get, the more your portfolio should look like a well-tended garden, not a high-speed trading floor. Yet too many people, especially at 60 plus, get seduced by fancy investments, convoluted tax strategies, or constantly shifting allocations. But complexity doesn't mean sophistication. It usually means fragility. Think about it. If you can't explain an investment in one sentence, you probably shouldn't own it. Annuities with layers of fees, leveraged ETF, or illiquid partnerships might sound impressive, but they're often just expensive ways to take on hidden risks. And when things go wrong, and they will, you're left holding the bag. Even diversification can backfire if it's overdone. Owning 50 stocks isn't safer than owning 10 great ones. It's just harder to manage, and at 60, you don't need to outsmart the market, you need to outlast it. That means fewer moving parts, not more. The best portfolios are boring. A handful of solid assets, low costs, and the discipline to leave them alone. Because in the end, simplicity isn't just easier, it's smarter. No one wants to think about it, but a single health disaster can undo a lifetime of savings faster than any bad investment. And at 60, the odds aren't in your favor. A major illness, long-term care need, or even a simple accident can drain 6 figures from your nest egg before you know it. Yet most people plan for market crashes, not hospital stays. The mistake, assuming Medicare will cover everything, it won't. Long-term care not covered, major prescriptions, often a gap. And if you're forced to sell investments during a downturn to pay medical bills, that's a double blow. You're not just paying for care, you're locking in losses. Even healthy retirees get blindsided. A fall, a sudden diagnosis, or a spouse's illness can change everything overnight. And without a plan, you're left choosing between financial ruin and cutting corners on care. A choice no one should face. The fix, plan for the worst, even if you expect the best. Long-term care insurance, a dedicated emergency fund, and a realistic Medicare supplement plan aren't luxuries. They are the ultimate insurance for your wealth, because at this age, protecting your health is just as important as protecting your portfolio. So as you stand at this crossroads, 60 years of wisdom behind you, and the rest of your life ahead, ask yourself one question. Are you building a fortress or a house of cards? Because the choices you make now won't just decide your comfort. They'll decide your legacy. Money isn't just numbers on a screen. It's the freedom to enjoy your grandkids' laughter without worry. It's the ability to help a family member in need without hesitation. It's waking up at 75 knowing you can still say yes to life. So do this for me, for you. Take that brilliant mind that built your wealth and use it to protect what matters, not with fear, but with the calm certainty of someone who knows the game. Because the richest retirement isn't the one with the most zeros. It's the one where you never have to say, I wish I'd known better.